Investing in a Roth IRA in your 20s, 30s, and 40s. In your 20s, when you invest in a Roth IRA, you give your contributions decades to grow tax-free. Roth IRAs are funded with after-tax money, so when you withdraw in retirement, both the contributions and the earnings can be taken out tax-free. Starting early maximizes the benefit of compound interest, meaning your money has more time to grow exponentially. You are likely in a lower tax bracket in your 20s, so contributing now allows you to lock in the tax benefit at a time when your taxable income is lower. This strategy will shield you from potentially higher taxes when you're earning more in your later years. Contributions to a Roth IRA, but not earnings, can be withdrawn without penalty, which provides a safety net in case you need access to your money before retirement. In your 30s, you still have around 30 years before you retire, so a Roth IRA continues to offer tax-free growth on investments. Compounding has already started working in your favor if you started in your 20s, and by maintaining consistent contributions, you can grow your retirement account significantly. You might be earning more in your 30s compared to your 20s, and having tax-free income in retirement becomes more valuable as your wealth grows. The ability to withdraw tax-free can help manage taxes in retirement when you're likely in a higher tax bracket. In your 30s, you're in a better financial position to maximize your contributions each year. The more you contribute, the more you can capitalize on tax-free gains over time. In your 40s, retirement might be within 20 years. You've likely seen income growth over the past decade, so continuing to contribute to a Roth IRA ensures you have a tax-diversified income in retirement. This allows you to strategically withdraw from both taxable and tax-free accounts to manage your tax liabilities. Starting at age 50, you can make catch-up contributions, increasing the annual amount you're allowed to contribute. This helps boost your retirement savings in the final years before retirement. Roth IRAs have advantages in estate planning. They do not have required minimum distributions during your lifetime, meaning your assets can continue to grow tax-free, and beneficiaries can inherit the Roth IRA without immediate tax implications. Why invest in ETFs like SPY, QQQ, VOO, IVV, VTI, and VUG? Well, these ETFs offer a diversified portfolio which can help reduce risk. They track major indices, providing exposure to a wide range of stocks. Plus, they often come with lower fees compared to mutual funds, making them a cost-effective option. So, whether you're looking for growth, income, or a balanced approach, these ETFs can be a great addition to your investment strategy. In your 20s, SPY, VOO, and IVV, which are S&P 500 ETFs, give you broad exposure to the 500 largest US companies. They are perfect for long-term investors because they track the overall stock market's performance, which has historically provided solid returns over time. In your 20s, you can take on market volatility and benefit from the long-term upward trend of the S&P 500. QQQ, the Nasdaq 100 ETF, focuses on tech-heavy companies in the Nasdaq 100, which tend to be growth-oriented. In your 20s, you have time to weather the ups and downs of more volatile sectors like technology, so QQQ could provide higher returns over the long term. VTI, the total stock market ETF, gives you exposure to the entire US stock market, including small, mid, and large cap companies. This broad diversification is ideal in your 20s when you want to capture the growth potential of the entire US economy, not just the largest companies. VUG, the growth ETF, focuses on companies with high growth potential. While growth stocks can be volatile, investing in VUG in your 20s allows you to capitalize on the potential for significant growth over the long term. In your 30s, SPY, VOO, and IVV. In your 30s, you might want to start balancing growth with stability. These ETFs provide the right combination of broad market exposure and lower risk compared to sector-specific ETFs. The S&P 500 consistently delivers long-term returns, making it a core investment in your portfolio. QQQ. The technology sector is likely still growing, so having exposure to companies like Apple, Amazon, and Google can offer substantial returns. QQQ can serve as the growth component in your portfolio. VTI. In your 30s, diversification remains key. VTI gives you exposure to the entire stock market, balancing growth and risk by including small and mid-cap companies alongside large caps. VUG. Growth stocks tend to outperform over the long run, and in your 30s, you still have enough time to let these stocks mature. VUG can provide higher returns, though you should also balance it with more stable investments. In your 40s, SPY, VOO, and IVV. Stability becomes more important as retirement approaches. These ETFs still provide solid growth, but they are more stable than sector-specific ETFs. They can continue to grow your wealth while limiting exposure to excessive risk. QQQ. Even in your 40s, having exposure to tech and growth companies is important for long-term growth. QQQ offers a good balance of innovation and performance in a sector that continues to grow. VTI. As you approach retirement, broad market exposure remains valuable. VTI offers exposure to the entire US stock market, which helps spread risk while still providing growth opportunities. VUG. Growth stocks can still play a role in your portfolio, but by your 40s, you might want to limit exposure to reduce risk. A smaller allocation to VUG can provide upside potential while being balanced with safer investments. Why these ETFs make sense at any age: diversification. All of these ETFs offer broad diversification, either across the entire US stock market or within specific sectors like large cap or growth stocks. Diversification helps manage risk and provides smoother returns over time. Low costs. ETFs like VOO, IVV, and VTI are low-cost ways to invest in the market. Low expense ratios mean more of your money stays invested, compounding over time. Consistent growth. The S&P 500 has delivered strong historical returns, and investing in ETFs like SPY, VOO, or IVV ensures that you capture the long-term growth of the market. Technology exposure. QQQ and VUG provide exposure to high-growth sectors like technology, which have been major drivers of market returns in recent years. Total market exposure. VTI offers exposure to the entire US stock market, giving you the benefits of large, mid, and small-cap stocks in one investment. In summary, investing in a Roth IRA and these ETFs offers the perfect combination of tax-free growth, broad market exposure, and a balance of stability and growth potential at every stage of your life.